Thank you very much, Taj. I'd like to thank the Congress for that welcome and for this opportunity. It is truly a great pleasure for me to address this Congress. It's a pleasure to be back in Liverpool, and it's an important time. It's an important time to discuss conditions in the UK labour market, and that's what I'm going to focus on exclusively in my prepared remarks. And I'm going to do that because, as you well know, the growth and distribution of jobs and incomes matter to everyone. Employment does much more than provide the means to support families. It's essential to personal fulfillment and to human dignity. And part of that dignity is being paid a living wage. Over the past year, at the Bank of England, we've ensured that we pay all of our staff at least a living wage. And we've recently brought up all our contracted service staff in central London to the London living wage. And because it's important to get this absolutely right, we're going through our final review. But I want to make it absolutely clear, but by the time of the next TUC Congress, our intention is to become an accredited living wage employer. So you don't just have to take my word for it. Now, of course, the Bank of England's responsibilities for promoting the good of the people of the United Kingdom go much, much further than being a responsible employer. We manage monetary policy to achieve price stability. In other words, low, stable, and predictable inflation. And we promote financial stability by regulating and supervising banks, as well as taking action to ensure against unsustainable indebtedness, such as we did earlier this year for the housing market. By maintaining price and financial stability, we put in place the foundations for sustainable job creation and income growth. And it's that stability that gives workers the confidence to invest in skills or to change jobs. And it gives businesses the confidence to hire new workers, to invest in new equipment, to introduce new products, or to pursue new markets. We obviously need the right workers with the right skills, and we need our companies taking the strategic initiatives to grow productivity, because it's productivity that will secure the real wage increases that British workers deserve over the medium term. Now, as I've started to explain, and I think it's clear, the labor market is central to the bank's decisions. Decisions which have to take into account both short-term fluctuations in employment and profound changes that are sweeping labor markets across the advanced economies. These changes include powerful demographic forces, notably the aging of the workforce, increases in longevity, and increased female participation. They include, as you were just discussing, I think, how globalization and new technologies are splitting production chains, not just across companies, but across borders. How financial risk is steadily shifting to employees from employers and from the state. And finally, how job polarization is increasing. That is, the phenomenon that the employment share of middle-skilled jobs is being reduced relative to higher and lower-skilled employment. So collectively, all of these forces have been acting for some time. They all affect the dynamism of our labor market, and they affect the spending patterns of families. And so as a central bank, the Bank of England has to assess the extent to which these structural changes have an impact on the economy, on labor markets, on the economy, on inflation. And we're grappling with what it means for monetary policy. And that's not unique to us. That's the same across the advanced world. It's the same in the US. It's the same in Europe. And the answers to these questions, the weight of these forces are different in different economies. And that's one reason why monetary policy in the United States, in the euro area, and here in the UK, can be expected to be less synchronized in the future than they have been in recent years. Indeed, despite common underlying influences, differences in how labor markets of the major economies have performed in response to the Great Recession have been striking. Let's take the world's largest economy, still the United States. Let's take that as a benchmark. Unemployment there more than doubled during the recession, and that unemployment rate has recently fallen back, but the headline is much better than the details. The number of Americans in work has only just returned to where it was before Lehman Brothers failed 6 years ago, even though there are now 14 million more Americans of working age. And much of the fall in the unemployment rate in the United States is the result of workers in their prime actually leaving the labor force. In other words, giving up and stopping looking for work. In addition, far more vacancies are unfilled than usual, indicating that there are big mismatches between skills in the labor market, skills and jobs in the labor market. And fewer people are switching jobs, suggesting a reluctance to take risks. In short, the American labor market still isn't working as it used to. Turning to the UK, even though times for many families here have been very tough, in comparison to the United States, the UK labor market has performed well. Despite a recession that was deeper and more prolonged than the United States, unemployment didn't rise as much in the UK, and it's fallen back almost as sharply as it did in the US. As important, or in fact more importantly, in contrast to the United States, this rapid fall in unemployment here has been accompanied by significantly higher participation rates. There are now 1 million more people in work in the UK than at the start of the crisis. But as this Congress knows, as the theme of this Congress illustrates, that exceptional employment performance has come at a cost. Wage growth has been very weak. In fact, adjusted for inflation, wages have fallen by 1/10 since the onset of the crisis. And in order to find such a fall in the past, you'd have to go back to the early 1920s. What's happened, in effect, has been the weakness of pay has purchased that increased job creation. The burden, said another way, the burden of the Great Recession has been shared across this country. Profits have been squeezed almost as much as labor costs. Employees have seen their real incomes reduced, but more people are at work as a result. What's made the performance even more remarkable is that we have faced the additional challenge, unlike the Americans, we face the additional challenge of rebuilding competitiveness. If you look over the channel to the euro area, they had a similar challenge. But they had to face that challenge with less flexible labor markets and less flexibility in their currency. And the results have been dire. Euro area unemployment has risen sharply through 2 recessions. It now stands at over 11%. It's over 14% in Portugal, 20% in Spain, 25% in Greece. And there is a clear danger of a misplaced, if not lost, generation of workers in the US as well as the euro area. Britain's labor force and Britain's trade unions deserve great credit for ensuring that this risk of a lost generation, is much lower here in the UK. By sharing the burden of the recession, our economy is better positioned for the future, but the question you're asking is whether we'll seize this opportunity. Now, before I talk a bit about how we could seize that opportunity, I think it's helpful to understand a bit more why the UK labor market outperformed, or at least outperformed in terms of employment. What happened was, when the recession hit, naturally the demand for work fell, but surprisingly, the potential supply of labor appears to have increased at the same time. The number of additional people wanting to work actually overwhelmed the longer-term effects of population aging. So why was that the case? Well, it appears that greater risks and financial burdens that many families are now facing have been driving this phenomena. Changes to pension arrangements have encouraged people to work longer. Reforms to the UK's welfare system, including attaching job search conditions to welfare payments, are prompting those affected to seek work. But on top of all of that, sharp falls in wealth and increased uncertainty about future incomes following the financial crisis have undoubtedly forced many people to retire later in order to compensate, and the scale of the debts weighing on British households has undoubtedly encouraged more people to work and to work for longer. So the strong performance of the UK labour market reflects, in part, people feeling compelled to work for financial and other reasons. Now, again, to their great credit, to your great credit, when British workers have been challenged, they haven't given up. Some have taken on less productive or lower skilled jobs. Others are working part-time. Some have become self-employed. Others are prepared to do the same work for less than they would have done. You bring that together to wage pressures. Wage pressures based on past relationships are as low today as if the unemployment rate were 10%, not the 6.4% rate it currently is. Basically, with more people, more workers at competitive wages, companies have been encouraged to hire, and they've substituted labor for capital across the economy. This dynamic, substitution of labor for capital, has lowered productivity. But that's not the result. That weak productivity growth isn't the result of laziness on anyone's part. It's the natural consequence of so many people wanting to work and companies employing them instead of investing in capital. One of my points is that although this adjustment's been painful, trading off lower productivity and lower wages for much higher, and it is much, much higher employment, on balance, that trade-off provides a solid foundation for a durable expansion. By staying in work, individuals retain and learn new skills, and they're better placed to participate in the expansion as it gathers force. So the consequence of all this is that Britain has an opportunity, seldom seen after a deep and prolonged recession, to reach and sustain a higher level of employment than the past. And workers have an opportunity now to maximize their pay prospects. But you're rightly asking, when will this start? When will Britain get a pay rise? Well, as employment approaches its new higher level, wage pressures should increase and capital investment should continue to recover. Productivity growth should pick up, bringing the higher sustainable pay rises that British workers deserve. Specifically, the bank's latest forecast expects real wage growth to resume around the middle of next year and then to accelerate as the unemployment rate continues to fall to around 5.5% over the next 3 years. By the end of our forecast, we see 4% nominal pay growth on average across the economy. And this is consistent both with our inflation target, which is our core mandate, consistent both with our inflation target and with the economy's potential. Now, I'll touch on, at the end of my remarks, how workers and employers can raise that potential and, as a consequence, raise the size of that pay rise. But let me first turn to the implications of all these developments for monetary policy. As I said at the outset, one of our roles at the Bank of England is to deliver price stability and do so in a way that supports jobs and growth. Our price stability objective is clear, an inflation target of 2% consumer price inflation. Supporting jobs means helping the economy reach the maximum sustainable level of employment. And what we have to recognize, and the reason I went through all those dynamics and forces in the labor market, what we have to recognize is that sustainable level of employment changes over time. a little more than a year ago, even though inflation had been above target for almost 5 years, even though growth was returning and was poised to accelerate, the Bank of England didn't raise interest rates from their historic low of 0.5%. We didn't raise interest rates because we recognized that the UK had a huge number of unemployed and underemployed workers. We didn't raise interest rates because we knew the economy was running below full capacity. We didn't raise interest rates because we expected inflation to fall back. We didn't raise interest rates because we saw that confidence might have been returning, but we knew it remained fragile. And in short, we didn't raise interest rates because we knew the nascent recovery that began about 15 months ago, that recovery was not yet secure. So what we did do was to use the flexibility in our remit, the flexibility in our mandate, to return inflation to target over a longer period than usual in order to support sustainable jobs and growth. And in order to make our intentions clear, the bank committed not even to think about raising interest rates until unemployment fell back to at least 7%. That so-called forward guidance gave businesses the confidence to hire and invest, and it reassured households that the costs of servicing their debts were not about to rise suddenly just because the economy was returning to growth. The effectiveness of that policy was reinforced by actions taken to help heal the banks and the rest of the financial sector. And the resultant recovery has exceeded all expectations. This recovery has momentum. Over 800,000 jobs have been created in the past year alone, and we expect robust economic growth of 3.5% this year and 3% next. But that's not enough. The challenge now is not to nurture a nascent recovery. We've done that. The challenge now is to secure a durable expansion and to make sure this economy realizes its full potential. Now, an obvious question is, what does that mean for interest rates? We're in a position where many of the conditions, many but not all, many of the conditions for the economy to normalize have now been met. And with that, the point at which interest rates also begin to normalize is getting closer. In recent months, the judgment about precisely when to raise bank rate from its historic low has become more balanced. But the bank doesn't have a preset course. The timing of these moves will depend on the data, will depend on how the economy evolves. Moreover, the precise timing of the first rate rise is much less important than our expectation that when rates do begin to rise, those increases are likely to be gradual and limited. Interest rates will only go up as far and as fast as is consistent with price stability as part of a durable expansion with the maximum sustainable level of employment. For a variety of reasons, ranging from the weakness in the euro area to that ongoing repair of household balance sheets that I spoke about in a moment ago, we are not expecting interest rates to head back to the levels seen before the Great Recession. Now, the actual path of interest rates will be determined by the balance of aggregate supply and demand in the economy. Before the crisis hit, these decisions were somewhat easier. Monetary policy largely tracked developments in aggregate demand because the structural dynamics of labor supply and the rate of productivity growth in the economy, both of those were relatively constant. But in the wake of the crisis, the supply side of the economy has been anything but predictable. Now, if I had been here a year and a half ago, I would have said that we thought at that point the major uncertainties on the supply side centered around productivity growth. But as we've observed wages, employment, and productivity evolve in recent quarters, we're increasingly of the view that there's been a material labor supply shock for the reasons that I've just discussed. So our forecasts for the next 3 years, our economic forecasts for the next 3 years, and hence our judgments about interest rate decisions, are based on some key judgments about the labor market. Particularly, that the number of people participating in the labor force will continue to rise. Secondly, that the unemployment rate that the economy can sustain without generating accelerating inflation will return to where it was before the Great Recession, in contrast with some other major economies. And thirdly, that there's scope for average hours worked, or for the average hours that people work, to continue to increase. In short, unlike the US, unlike the euro area, the British economy is likely able to sustain a higher level of employment than in the past. And our uncertainty is less about the direction of this change than about the magnitude. And in order to assess the magnitude of this change, this higher level of employment, and to assess its implications for inflation, we're tracking a range of indicators, including those of the prospective paths for wages and unit labor costs. Now, actual wage growth, as you've been discussing, is currently very weak. It's just 0.6% excluding bonuses. There are beginning, however, to be some leading indicators that point to a modest pickup in coming quarters. For example, job-to-job flows have been increasing, and some surveys of pay growth have picked up more sharply in the last year. This offers some encouragement of better wage prospects for those changing or finding new jobs. But of course, the pay of existing employees needs to pick up as well. After all, what matters for economy-wide inflation is the average wage relative to economy-wide productivity. And to that end, the bank will be monitoring closely pay settlements that are bunched towards the end of towards the turn of the year, and we'll be taking a steer from the pay of new hires more as a potential leading indicator of broader pay pressures. Now, some observers have discounted the implications for inflation of recent weakness of pay growth because some of it stems from the types of jobs that are being filled. But these are real jobs being performed by real people. And an increase in lower skilled, lower wage jobs is one consequence of working off this labor supply shock. And we also need to be mindful of those longer term trends I spoke of at the start. We also need to be mindful, in other words, that this could represent part of a trend towards greater job polarization. The point is, what matters for inflationary pressures, irrespective of the type of job, is the relationship between wages and productivity, and that relationship is captured by unit labor costs. And when we look across the economy at the moment, wage growth is barely above productivity growth, and soft unit labor costs indicate that there's further to go before we reach the new sustainable level of employment. In other words, there's still slack in the labor market. That slack is wasteful, and if it were to remain, inflation would remain below the 2% target. Now, our best current collective judgment is that while it has narrowed rapidly, while the degree of slack has narrowed rapidly, slack remains broadly in the region of 1% of GDP. As I said a moment ago, as this margin of slack continues to narrow, we expect wages to pick up slightly faster than productivity. However, we expect that it will take a better part of 3 years for this to happen materially enough to bring inflation back to target. With inflation at 1.6%, continuing downward pressure from past appreciation of sterling, and with that margin of slack remaining, the current inflation environment is benign. But it won't remain benign if we don't increase rates prudently as the expansion progresses. The bank's latest forecasts show that if interest rates were to follow broadly the path expected by markets, or at least the path expected by markets in August, that is beginning to increase by the spring, and thereafter rising very gradually, inflation would settle around 2% by the end of our forecast, and a further 1.2 million jobs would be created. In other words, we would achieve our mandate. Now that's a forecast, and there's always uncertainty about the future. But uncertainty doesn't mean stasis. You can expect interest rates to begin to increase. The exact path of interest rates will depend on the economy, and the bank's assessment will undoubtedly change as the economy evolves, and of course policy will be adjusted if geopolitical events have a material impact on the outlook. If indicators suggest that the economy is moving more slowly towards our goals, we'll have learned that we're further from sustainable capacity. Prospective wages and unit labor cost growth will be weaker, and rates will go up later and more gradually. But if we see faster progress, prospective wages and unit labor cost growth will be stronger, which will suggest we are closer to maximum capacity in the economy, and that the economy can sustain higher rates sooner. But in all of those scenarios, rate rises can be expected to be gradual and limited compared to the experience of the UK in the past. So let me conclude and we'll get to questions. Look, we're under no illusions. The Great Recession was a calamity, and British workers have borne many of the consequences. Our job at the Bank of England is to maintain price and financial stability, because price and financial stability support sustainable growth in jobs and incomes. But monetary policy can't do it alone. Others, including trade unions, governments, and businesses, you will determine the potential of this economy. You will ultimately determine the size of Britain's pay rise. Those in work need to be able to seize new job opportunities in a world where technology and globalization cause labor markets to shift rapidly. As you've been discussing over the last day and a half, but much longer, skill levels need to be raised continually. That's first and foremost clearly about education, but crucially it also means access to lifelong learning, both on and off the job, and access that's available to all. And the TUC's engagement with the UK skills agenda is a major contribution to achieving that imperative. As just one example, in the past year alone, Union Learn helped more than 200,000 people invest in their skills. And these are the type of investments that are absolutely crucial for the durability of this expansion and for Britain's future. These are the type of investments that will help deliver long-term productivity so that the British people get the pay rise that they deserve. Thank you very much for your attention. I'll take it.
Mark, I would like to thank you for your address. And before I ask Francis to join you to facilitate a question and answer session, let me just say that every year, every president has a theme to choose, and mine this year was End Low Pay. I just want to thank you for ending low pay for your employees. Well done. I'm now inviting Francis to join and facilitate a question and answer session.
Thank you very much, President. And I hope, President, with your agreement, we might just go on a little bit longer, just so that we can get a few questions in. But,
Agreed? Thank you.
But the brisker and shorter those questions are, and if I group them, then hopefully the Governor can answer them concisely too. So could we kick off first, please, with 2 questions on the public sector from Unison and SOR.
Ash Wolframson on behalf of Unison. A report for Unison by Landman Economics found the cost of the government of increasing public sector pay is significantly less than might be expected. This is partly due to the extra demand generated as pay increases. Every 1% increase in public sector pay injects between £470 and £880 million of extra value into the economy. Given the Governor's previous concerns about the need to see wages improving before interest rates are raised, would he therefore agree that much more needs to be done to boost the take-home pay of public sector workers?
Steve Herring, Vice President of the Society and College of Radiographers. Our question is, our members in the NHS are facing yet another pay freeze, the fourth in 5 years, while average earnings growth across the economy continues to lag behind price increases. What are the consequences for long-term economic stability if working people are denied the benefits of an improving economy?
Yeah, okay. Well, very important question. Let me say at the outset, absolutely recognize I quoted the figure, which is an aggregate economy-wide figure. Everyone's aware of this, but a 10% fall in real incomes since the crisis. But that's across the economy. The hit in the public sector has been larger, and we're well aware of that. And that creates real difficulty. It's one of the reasons why we are very conscious about the pace and degree of potential interest rate increases, the timing, pace, and degree of potential rate increases. We need to see the prospects of wage growth coming in, real wage growth across the economy, including through the public sector. Now, let me just stress two other points. First is that ultimately, wage growth in the public sector, wage growth across the economy is going to be determined by productivity. So what we're doing is trying to put in place the conditions to maximize that and ensure that it flows through. And I'll emphasize that from a financial stability perspective, because you raised the second question on financial stability, this is something we are taking very seriously. It's one of the reasons why we acted on housing earlier this year, because we had concern about, in an environment of low pay growth, amongst other factors, that the debt burden that could be built up through the housing market would weigh on this economy, not just next year and the year after that, but much further out, and very materially reduce incomes and livelihoods, not just for public sector workers, but workers across the UK.
Thank you very much. I've got a group of 3 questions, 2 on interest rates from Unite and GMB, and then 1 from Equity on investment.
Good afternoon. Dawn McAllister, Unite Scottish Executive Member. Millions of people are over-indebted, and my union Unite has highlighted how many people have to borrow from payday lenders to get through the month because of low wages and cuts in real wages. An interest rate rise is likely to have a wide social and economic fallout, as people can no longer make ends meet, and many will face the prospect of losing their homes. How much is the Bank of England going to consider this, and whether wages have increased when looking at whether to raise interest rates?
Hi, Kath Murphy, GMB Scotland. You said that when unemployment rate fell below 7%, interest rates would rise as part of an economic strategy on inflation. You did not follow that through. Is this because of the impact a rise in interest rates would have on millions of working people, or was it something to do with the pressures politically not to support interest rates this side of an election?
Linda Rook, Equity. Is there a place for regulation to ensure economic stimulus is delivered to the wider UK economy as opposed to only the financial sector? For example, to the powerhouse that is the creative industries, which delivered 15.6% of GVA in 2012. Thank you.
Okay. Very good. If I try to group them, sort of there's 3 aspects here. The first, and I welcome the focus, because it's absolutely essential, this focus on indebtedness of British households, the sensitivity to interest rates, and what that means for monetary policy, because ultimately it's what it means for growth, the pressures on inflation, what it means for monetary policy. We are very sensitive to this. We conduct extensive analysis of not just economy-wide indebtedness, but cohorts or groups of people within the economy and how indebted they are. We see that through surveys and other analysis, 40% of British households feel acutely the weight of their indebtedness, and we look at how they would adjust to potential rate increases. It's one of the factors that influences, without question, the path of monetary policy and the durability of the recovery, or the expansion rather. So what's important is that there is a prospect of wage increases. There's a real prospect of wage increases, and those wage increases are coming through because that helps to reduce the burden of that indebtedness. And what I was concentrating on in the speech is the dynamic as this extra workforce finds employment, in economist speak, as the slack is used up in the terrible way to talk about it, but as it's used up in the labor market, then we start to see those prospects. But we are very alert to this issue, and it influences all our policies. That's the first point. The second point, because both there was the reference to payday lenders, but then there was the reference to bank lending, particularly I think to the creative industries, which is an important point. There is a radical restructuring going on, which isn't finished, but it is in train, of the banking sector in this country. We have fundamentally changed the cost of banking to the banks of various activities. It is much, much more expensive for banks to engage in trading in the city, investing in financial markets, as opposed to lending to the real economy. Now, these are big, somewhat lumbering institutions, and it takes them a while to adjust. But they need to be successful. They need to build the skills to lend to businesses. And as you know, at Equality, you know that much of the future of this country is in the creative industries, is in industries where the basic assets are human capital and ideas and imagination. And so those banks need to be able to make the credit decisions around lending into those industries. It will take them a while, but the incentives are there, and they're much more resilient in order to be able to do that. Vis-a-vis payday lenders and others, what's important is that there are new banks that can come in and compete against these very high rates of interest and very ineffective rates of interest for households. And so we have streamlined the ability of new banks to come in, and we've had a fourfold increase in the amount of applications and the number of new challenger banks that are coming through. Again, we have to do more, but that's a focus of ours. This last point, just on interest rates and politics. Is the way I would term it. The first thing to say is we're absolutely indifferent to the political cycle, to who's in government, who might be in government, who was in government. We're given a specific mandate. It's basically unchanged since 1997, achieve that 2% inflation target. And we manage monetary policy in order to achieve that, and if we need to raise interest rates before or lower them for that matter, before a vote or an election or a referendum or anything, we will do what is necessary in order to achieve that target. We are technocrats and we do what's necessary. I just, if you don't mind, I just want to clarify one thing. I think most people are clear, but our commitment about not raising interest rates, our commitment was not to raise interest rates at least until unemployment got to 7%, because we wanted to secure that recovery. And what we said was once the unemployment rate got to 7%, we would then look around, take stock, and decide where monetary policy needed to go. And when we looked around and took stock, we saw a lot more people who wanted to work than had jobs. We saw a lot of people working part-time that wanted to work full-time, a lot of people working self-employed that wanted to be in regular employment. We saw a lot of people on zero-hour contracts. We saw a lot of flexibility, a lot of additional capacity in the labor market. It didn't make sense to raise interest rates, was our judgment then, and it's been absolutely vindicated by the performance of the economy since.
Thank you very much, Mark. Two more questions, one from PCS on taxation and one from SCP on housing.
Thanks, Francis. Good morning, Mr. Carney. PCS represents over 50,000 workers in revenue and customs. Our estimate is that there's over 120 billion in tax avoided, evaded and uncollected. We hope you're making the case with the government that in this situation, HMRC should employ more staff rather than cut jobs in order to enable this tax to be collected. But our question to you as the Governor of the Bank of England is this. The richest 10% pay a lower share of their income in tax than the poorest 10%. Do you believe there is a case for making the tax system more redistributive?
Patricia Schooling, the SCP. Ordinary people are struggling to buy their own homes as a result of the so-called housing bubble. This is a huge problem for young workers who are low paid and often paying off university debts. Is the Bank of England planning to take any steps to take the heat out of the housing market, and will a rise in interest rates make the situation better or worse?
Okay, let me, I'll start with the housing and then I'll go to inequality. Let me say first about housing. We have a range of tools at the Bank of England. The Bank of England has changed in recent years. It used to be that we basically could just vary interest rates, and one of the challenges was there might be a temptation to use interest rates against an issue such as you're describing in the housing market and sustainable growth as described in house prices. We now have another range of tools that we can use, and so we can preserve interest rates, monetary policy, for achieving inflation, but achieving inflation, the inflation target, in a way that supports jobs and growth, and that's what we're doing. So what are we doing on housing, and how do we view that situation? What we did on housing in June was that we took a series of steps that in effect took out insurance against developments in the housing market that wouldn't be consistent with the long-term growth of this economy. We restricted banks' ability to make risky loans, risky mortgages. We capped the amount of those mortgages that they could do. Working with other agencies, we're making sure that banks do proper credit checks and credit analysis, so they're concentrating their resources on people who deserve those mortgages. And we're making sure that those mortgages are being shocked to higher interest rates, so that when people get a new mortgage, they know that they can pay that mortgage if interest rates adjust. The consequence of all those measures, the intent was not to target house prices per se. It wasn't to stop the housing market in the tracks. There's a number of you here who know that housing markets in your region are just beginning to recover. But it was to make sure that certain housing markets, and certainly the housing market across this country, doesn't move unsustainably, supported by unsustainable debts. That's what we can do in the housing market. We can take other steps. But let me also acknowledge our limitations. We can't build houses. The fundamental problem in this housing market is a lack of supply. And that's going to take efforts from many others for many, many years in order to address the lack of supply. With respect to inequality, I'm afraid on fiscal policy and tax policy, it's not our responsibility. We have many responsibilities. I just talked about housing, but it's not one of our responsibilities. So I'm not going to drift into dictating tax policy. But these issues have real consequences for our policies. The shift in wage growth, more rapid wage growth at the upper end, tepid or negative wage growth at the lower end. That affects inflation. We need to understand that. That affects our monetary policy. It's one of the reasons why one would expect this more gradual path, even though the economy is growing. And I'm going to repeat myself, but again, it goes back to who has the debts in this economy? What's their ability to service those debts? What does that mean if there's too rapid an adjustment in inflation or in interest rates? What does that mean for the sustainability of the economy? We're trying to do everything we can to put in place the conditions so that there is that growth that's going to bring into place sustainable wage increases for all.
Thanks very much, Mark. We've had lots and lots of questions on the cost of living, so we've got just two now, NUT and UCU.
Thank you. Good afternoon. Louise Regan, National Union of Teachers. International studies show that the greater the inequality in a country, the worse its educational outcomes. In your interview with William Keegan, printed in our conference programme, you talked about your worries about a waste of human capital in the UK. Do you accept that greater state intervention to strengthen the economy and reduce inequality will improve our children's education and life chances?
Hi, I'm Mamuna Shah, University and College Union. The recent ONS upwards revision of the numbers on zero-hours contracts and the growth in low-paid self-employment revealed that the labour market picture is not as rosy as previously thought. How will the bank reflect this reality of low pay and a disappearing middle in the quality of labour market data and plan for a fair and sustainable economy?
Let's talk about the near term, which is what you're raising, zero-hour contracts, self-employment, part-time, other figures. We're taking all of those very much into account, because if one just looked at the movement in the unemployment rate and the speed of the movement in the unemployment rate, one could draw a conclusion of a very tight labor market, very tight dynamics in labor market. But by looking behind, by looking at the number of people who want to work full-time but still can only find part-time work, people moving into self-employment, the increase in the participation rate, participation in the labor market, more people coming in looking for work, and the prospect of more of those coming, taking all those factors and others into account, that's why we do still see slack in this labor market, this 1% number I quoted. Now, there's a lot of uncertainty around that, and we're learning with every day about exactly where that is. But that's why we see that, and that's why the judgment, the collective judgment of the MPC, which is the committee of the bank that makes these decisions, has been to keep interest rates where they are. Now, what I'm saying today is consistent with what we've said recently, is you can expect interest rates to start to go up at some point, but it's within the context of how that slack is used up and what the prospects are for not just wage increases, but labor costs. On absolutely crucial questions around education. Can't stress enough, and you know this from your work and from your colleagues, how wasteful, there's nothing worse than wasting human capital. Now, I sound like an economist in saying it that way, but wasting a life, wasting skills, and people losing that. Now, there were two challenges. The first challenge after this recession was first to keep people in work as much as possible, because people lose their skills if they're out of work. It's just a reality. It's an unfortunate reality. And we in the UK have done better than others, virtually anyone else, in keeping people in work. But that's not enough. The whole point is around lifelong learning, building on the base that the teachers give employees. And it is from early childhood education, it's through formal education, but it is very much a skills agenda that evolves through lifetime. And it's not just for those in work, it's for those out of work. And it has to be available for all, which is why I wanted to stress that at the end. And I'll just hammer the point, if I may, which is that our contribution to the pay rise for which you're looking is to ensure that you get that which the economy today can sustain. But it's not clear you should be satisfied with that. That's the extent of what the Bank of England can do. The question is, how do you raise the level of pay that the economy can sustain? And part of the way you do it is through a very equal and broad-based investment in skills throughout an individual's lifetime.
Okay, thank you, Mark. I'd like to take a question from Usdaw next on independence.
Okay, Jeff Broom, Usdaw. With less than 2 weeks until the people of Scotland vote in the independence referendum, would an independent Scotland be able to remain in the currency union with the rest of the UK? And if not, what might be the consequences to the Scottish economy?
Well, I went to Edinburgh in January, and I gave a speech on this subject, on the economics of currency unions. And basically in that speech I said there are three components of a successful currency union. First, you have to have free movement of capital and labor and goods and services, trade. across the various parts of the currency union. Secondly, you need something called a banking union. In other words, you need the same regulation, the same supervision, same standards in the banking sector, and you, very importantly, need the institutions that stand behind those banks, the lender of last resort, which is a central bank, deposit guarantee scheme that's credible. You need all those institutions to be common. And thirdly, you need some form of fiscal arrangement. So you need tax, revenues, and spending flowing across those borders to help equalize to some extent the inevitable fluctuations, differences in the various economies. I think we only have to look across the channel what happens if you don't have all of those components in place. So that's just the economics of it. That outlines the economics of it. You know, I've said this before, but we take note of the positions of all the major Westminster parties to rule out a currency union between an independent Scotland and the rest of the UK. So it's in that context, just to put it together, in that context, a currency union is incompatible with sovereignty.
Okay, thank you. I think we can sneak in just one more from Prospects, please.
Good afternoon, Mr. Carney. I'm Lorna Daniel. I'm representing Prospect. Last July, when you announced that Jane Austen would be featuring on the £10 banknote, you also made a welcome commitment that future banknotes should celebrate the full diversity of great British historical figures and their contributions in a wide range of fields. Do you think this commitment to greater diversity should include the composition of the Monetary Policy Committee?
Yeah. Well, I do, actually. I think I've said that. No, let me say a couple of things. First, it was striking when I first came to the bank that the level of the gender balance in the senior ranks of the institution was not what I would have expected, nor does the staff of the bank yet fully reflect the diversity, the broader diversity of the United Kingdom. And so what have we done? And I should note that decisions of who's on the Monetary Policy Committee or any of our other committees are not for the senior management of the bank, but for the government, for the Chancellor. And that in the last year, very pleased that Kristen Forbes and Manoush Shafiq both have joined, and they're both excellent colleagues. What we can influence, though, at the bank, and what we have been influencing, is the composition of our workforce. And here's what we've done. And it's 15 months, but here's what we've done. The year before, in our graduate intake, about a quarter of new hires were female. In the most recent graduate intake, which came in August, just under half female. In our senior management ranks, the top 50 senior managers, a fifth were female. Now it's about a third. We've set up a specific task force, targets. We're actively recruiting to get a balance. We have as you would expect, we have a strategic plan. This is one of our fundamental objectives of the strategic plan, is that our workforce at the Bank of England fully reflects the diversity of the United Kingdom, because it's not just the right thing to do, it will make us much, much more effective. And it's going to take years to do it. We've made a good start. But I'm glad to end with that question because it's fundamental to what we need to do. So thank you.
Thank you. I think, Governor, if you're looking for new talent on the MPC, I think that sister from Prospect is available. Apologies to delegates who we weren't able to take questions from, but I think you'll agree that was a really good Q&A round, and thank you very much indeed, Governor, for giving us more time to answer them.
Thank you, Francis, and once again, thank you, Mark, for your contribution.